Although we are now in the middle of winter, the real estate market has not shown many signs of cooling. In your January real estate market update, I'm going to touch on mortgage rates, inventory, home equity, and prices, and give you a little bit idea on what we should expect as we move further into 2022. Hi, this is Andrew with the S2 Real Estate team of eXp Realty. And, normally this time of the year, the real estate market cools. It's when it takes a step back. Activity and everything is at its lowest. But if you caught the update that I did last week, where I touched on just a couple of points, you'll know that we actually took a little bit of a break and then unexpectedly got very, very active again. So what does that mean for us, or what can we expect as we move into 2022? Granted that we're only, a couple of weeks in to the new year so far. So as I mentioned at the beginning, in this month's real estate market update, I want to touch on mortgage rates. We're also going to touch on inventory, home equity, and home prices, as those are areas that are on a lot of people's minds, and I'm getting quite a few questions about them. So I'm going to share my screen with you here, and we'll run through all of those points and try and provide some clarity for you. So firstly, let's take a look at mortgage rates. Mortgage rates since about September have actually been moving quite sideways. They bounced up, they bounced down, they bounced up, they bounced down. But in the past week, they've jumped up. In fact, they went up about 0.5% in many instances. They did drop down a little bit and they've been bouncing around again. So while they're not increasing dramatically, it is obvious that we are in a rising rate environment. And there's a link to last week's video in the description below where I go into this and the projections for mortgage rates this year in more detail. But Bill McBride, the founder of Calculated Risk, he's someone that I refer to quite often. He offers a lot of great insights into everything that's going on. So one of the questions people have had is, with mortgage rates rising and expected to rise throughout the year, is that going to put a damper on the housing market? And what Bill has to say is it's possible that rising mortgage rates will slow the housing market, or the Fed might raise rates sooner than expected due to the recent pickup in inflation. But I believe one thing is certain: inventory will tell the tale. So what's he referring to here? Well, inventory has been the big driving factor behind the real estate market for well over a year now. Actually, going back even further than that, we've been in a falling inventory environment, meaning supply of homes has been falling while demand is going up. That in and amongst itself is what led to multiple offers and bidding wars, which inadvertently then, actually the result of that was prices being pushed up. So what Bill's saying here is that even though rates are moving right now, mortgage rates are not as big a factor as inventory is. So inventory is what we're going to take a look at here. Now, we've started the year with record low number of homes for sale. It's the lowest it's ever been. And it fell from last week again to this week. The question that we have now is, how long is it going to fall for, right? So if you go back and you look at a normal pattern, inventory usually falls until about the middle to the third week in January. Then it starts to pick up again. Last year was an exception. Inventory fell all the way until April. As demand, it was just a frenzied environment. If you or anyone you know was looking to buy a home, it was crazy. So what's it going to do this year? And the thing is, nobody knows. Nobody knows exactly what it's going to do this year. Everyone's kind of in a wait and see game. So if you look now, this is looking at December's inventory. So it's comparing December 2021 to December 2020. And the entire country, with the exception of Idaho, has lower inventory. The national average is the supply of homes is down 26.8%. Here in Texas, we're down 23.1%. California is down 27.8%. The other market that we cover, Arizona, is only down a little over 4%. It's not doing as bad. But the only market with positive inventory is Idaho. Idaho is up 55%. So that's going to be a market to keep an eye on. A lot of you may know that there was a huge influx into Idaho out of California with things being snapped up, and that's kind of slowed a little bit. So inventory is picking up there. It's up 55%, but 55% compared to what? I can tell you that in December of 2020, I had some people looking at buying investment property there, and there was literally nothing on the market. I mean, nothing at all. So if you have 10 homes for sale and it goes up 55%, it's not necessarily the sky is falling, but it's definitely something to keep an eye on. Now, what is interesting though, is what buyer activity has been doing in relation to the inventory. For us to see the inventory numbers recover, we either need a lot more supply to come onto the market, or we're going to see something have to take a chunk or a bite out of demand. And we're not seeing that right now. Showing time is a service that tracks the number of showings that are taking place on homes listed for sale across the country. This is the latest index they've published for November. So November is the latest month, and it's looking at the activity for the last 5 Novembers. Look at 2021. I mean, it's the highest activity there's been by a long shot at any time in the past 5 years. So buyer activity isn't going anywhere. But, why is that? Why are buyers increasing in numbers so much at this time of the year? To be honest with you, no one knows exactly for sure why. But one of the reasons, I've got a couple ideas that I'll share with you here. One is that many buyers that were sitting on the sidelines, kind of waiting for things to see what was going to happen, especially as the moratorium on foreclosures ended, they're not seeing more inventory. They're not seeing a wave of discounted properties come onto the market. You couple that with the fact that mortgage rates have started to go up. And I think many have started to realize that if we're going to buy a home, we're going to have to do it now before we get priced out any further, or before, it gets even more difficult than it is right now. Now, I'm not saying that the market that we're in is going to last forever. I'm the last one to believe that. I went through previous markets and the downturns before. What I can tell you is there's no signs of a dramatic slowdown right now. There's nothing in any of the leading indicators to indicate that we're going to see a dramatic change over what we're seeing right now. Now, one of the reasons for that, and I touched on this in last week's video about foreclosures, one thing that people have been talking about or predicting or saying is that we were going to see a wave of foreclosures. It was going to be a tsunami of foreclosures, just like 2008. And the fact of the matter is, it hasn't happened. And again, last week's video is linked in the description below, where I talk about what's going on with the mortgage forbearances and the fact that those homes are not coming to market, even as they exit forbearance. And one of the reasons for that is equity growth. Now, there's a lot of people out there that don't realize, a lot of homeowners, that is, that don't realize how much equity they have gained in the past 12 to 18 months. So this is going from third quarter of 2020 to third quarter of 2021. And you can see that on average, mortgaged homes in the United States gained $56,700 in equity. Here in Texas, it was about $43,000 on average. Arizona, 92,000, California, 119,000. So you can see these equity numbers are incredibly strong, but use the national average of 56,700 for a minute. So what about those homes in forbearance? Well, let's imagine for a minute you had someone that was paying a mortgage and interest of somewhere around $2,000 a month. They didn't make their payment for a year. Okay, so that's $24,000 in missed payments. Okay, say the lender adds late fees on there and penalties of $6,000. Okay, so now they've got $30,000 been added on to what they owe. On average, their home went up $56,700. So even though they didn't make a mortgage payment, they still gained wealth. They still gained equity overall based upon what happened in home values. So that home, if that person truly couldn't afford the mortgage anymore, the vast majority of people could simply put the home up for sale, sell it, and still clear all their obligations. That's one of the driving factors and one of the main reasons you haven't and won't see a massive number of foreclosures coming to the market. So again, as we can see, demand is still really high, and mortgage rates have not deterred home buyers at this point. So demand is really high, supply is really low. So what does that mean in terms of home prices? Well, here's where we're at. Now, this graph here is asking, have home price acceleration peaked? Now, I've been talking about this for a couple of months now, saying that obviously the pace of appreciation we had been seeing is not sustainable, right? It's definitely going to be unaffordable at some point in time. These ultra low mortgage rates can only keep things in balance for a certain amount of time. Now, in last week's video, I explained that here in Frisco, Texas, we actually saw the biggest jump in home prices between the end of January, early February, and the beginning of May. Between May and September, price gains were relatively flat. They were still up year over year, but month over month, they were flat. Okay. This is now looking at things from a national perspective, and it's going through November. And you can see that it's very, very similar to what's been experienced in other areas of the country. Now, please keep in mind that they're starting this graph at 10% annual price appreciation, which is obviously still very strong. But you can see here, whether it's the FHFA, CoreLogic, or S&P Case-Shiller, all popular reporting agencies, they all show that the peak happened right around July as far as this rapid run up in prices that we'd seen. Now, they all track their numbers slightly differently, which is why you see differences in what was the actual pace of appreciation. But the important thing here is they all showed a rapid run up in prices. They're all showing that they peaked around July, and now they're showing things either flatlining or starting to come down a little bit. Now, keep in mind, this is not saying that home prices are coming down. This is saying that the pace of appreciation is coming down. Even here, FHFA, they're showing here, they're still showing just over 17% as of November. Okay, so keep that in mind. So what does all of this mean as we go further into 2022? So right now, what it looks as though we are going to see for the first part of the year is exactly what we saw in 2021. Multiple offers and bidding wars are still going to be a part of our market. It's going to be extremely competitive, but it doesn't appear as though the pace of appreciation is going to go the way it did last year and just be rapid growth. We're seeing that settle. Although the latest data shows that the new listings that have come on the market in the past 7 days did have a fairly healthy jump in initial list prices. That is something that we will continue to watch. But for right now, it doesn't look as though we're going to see any major differences. So I hope this information helps. If you have any particular questions whatsoever or a situation you'd like to discuss in more detail, please don't hesitate to reach out. We'd be more than happy to talk to you and share additional information. You can reach us at 888-447-9650, or you can always send an email to contact@s2realestateteam.com.